Kia ora, and welcome to Tuesday's Economy Watch, where we follow the economic events and trends that affect New Zealand. I'm David Chaston, and this is the international edition from interest.co.nz, and today we lead with news the world has suddenly gotten far more dangerous after the US-Israeli strike on Iran. Shipping costs especially are in a dramatic rise on necessary rerouting. The cost of war will hit inflation soon, and that is a looming problem for central bank policymakers. And investors are demanding high yields from not only corporate paper, but benchmark government bonds as well. But first in the US, the February PMI from the widely watched ISM survey dipped very slightly from January, but held up better than analysts were expecting. It is only the third time, though, in 40 months that this metric shows an expansion. It was driven by prices and imports, both of which are rising faster. New order flows rose at a slower pace. This metric is basically the same as the parallel S&P Global Factory PMI for February, which noted faltering exports. This contrasts with the latest EU PMI, which reports its strongest rise in new factory orders since April 2022, taking their factory PMI to a 44-month high. But coming with it are building inflationary pressures. Driving this result is a notable uptick in Germany, which is now back in expansion. And the rise of Japanese manufacturing is now getting real momentum. Their February factory PMI burst out of its trend, confirming the January rise to be now at almost a 4-year high. This is on the back of output, new orders and employment that all expanded at their fastest pace since January 2022. Not to be outdone, Taiwan's factory PMI rose sharply too in February, although this also came with higher inflationary pressures than for Japan. Firms there are struggling to meet demand. In some other selected Asian nations, their factory PMIs were mostly positive. This is true for Vietnam, Indonesia and Thailand, although the same survey in Malaysia isn't quite so positive. Indian industrial production rose 4.8% in January from a year ago, and while most countries would love that, it represents a sharp slowing from December's 8% rise and way below the expected 6.5%. The December rate was unusual, however, and the January expansion mirrors what we saw for most of 2025. And China announced late yesterday that they had attracted 92 billion yuan in foreign direct investment in January. This was 5.7% less than in January 2025. But we probably should also note that the December FDI was quite good, standing out from the long run of negative flows. In Australia, the Melbourne Institute monthly inflation gauge reported an easing in monthly inflation in February, dipping 0.2% from January. The main influence was lower fuel prices. In annual terms, however, headline inflation remains elevated above the RBA's 2 to 3% target band and has exceeded the top end of the band for the past 6 months. Changes in monthly cost of living were mixed, with employee households experiencing the largest monthly increase. And staying in Australia, the Cotality Home Value Index rose 0.7% in February, easing slightly from a 0.8% gain in January. Price growth remained strong in Brisbane, Adelaide and Perth, but values were flat in Melbourne and Sydney. Year on year, national home values rose 9.6%, moderating from 10.2% in January. Globally, we should probably note that the aluminium price is up during this turmoil, now at a 4-year high, and tin has taken off, now at a record high. Copper is near a record high too, but it hasn't changed during this crisis. It's been at the current level all year. Also globally, we should note that air cargo demand rose 5.6% in January from a year ago, with international air freight up 7.2%, driven by the 9.4% rise in the Asia-Pacific region, and restrained by the 1.4% rise in North America. Meanwhile, passenger air travel rose 3.8%, with international travel up 5.9%. It is notable that domestic air travel fell in the US on a year-on-year basis, but it also did that in Australia as well. And ocean freight costs have surged in the past day, shocking many as ships needed to be rerouted away from the Middle East. The US Treasury 10-year yield is now just on 4.06%, up 10 basis points from this time yesterday. And the price of gold will start today up $18 from yesterday at $5,296 an ounce. Overnight it got up to a new record high of $5,415 an ounce, but has retraced since then. Silver is down a sharp $6 at $87 an ounce today, also after an interim burst higher. And American oil prices are up $3.50 at just on $70.50 a barrel, while the international Brent price is now up $4 to be just over $77 a barrel. These are 6% rises. Given the intensified Middle East tensions, it seems pretty restrained though. But European natural gas prices have leapt overnight. The Kiwi dollar is 70 basis points lower against the US dollar from yesterday, now just on 59.3 US cents. Against the Aussie, we're down 40 basis points at 83.9 Australian cents. We're down 20 basis points against the yen. Against the euro, we're unchanged though at 50.7 euro cents. That all means our trade-weighted index starts today down 50 basis points, now just on 62.9 and a one-month low. And the Bitcoin price starts today at $69,835 and up 5.5% from yesterday. Volatility over the past 24 hours has been high, at just on plus or minus 3.4%. You can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again tomorrow.